most expecting the central bank to raise interest rates. Our question, is it really a done deal? Ordinarily, Richard, I'd turn to the traders and ask them that question, but you've been in the room before, and I don't have the Fed chair on the set today. I have you. Is it a done deal?
Consolation prize.
They're going to raise rates today? What are they going to do?
I can't imagine they will not. I mean, I think the market's already discounted that, which is important. And the economy's doing well, particularly the consumption figures. So look at what the so-called casual diners have just reported. C is the biggest variable in the output equation. C plus I plus G plus or minus X, net exports. And C is still pumping along. So they gear themselves to the real economy. There are signs, autos, housing, interest rate sensitive sectors that are beginning to roll. But I would say that it would be a serious mistake not to, because what this is a risk management exercise in my view. What they want to do is have something to give back when indeed the economy begins to roll over.
Reload in case they need to.
Yeah, we fired every bullet we had when we did ZIRP, zero interest rate policy, and hammered down the yield curve through QE. And now they have to have something in their pocket, which they don't have much of, to mitigate a downturn. That's their job. Keep employment at maximum levels and also make sure we don't slide into inflation or deflation on the downside.
Stan Druckenmiller writes this week, the Fed should pause its double-barreled blitz of higher rates and tighter liquidity. Wall Street Journal editorial board, time for a Fed pause. Yeah. You heard Gundlach? I sat with him earlier this week. We played the sound already. These are smart people.
These are very smart people.
Saying don't do it. Well, the economy's not strong enough to do it. You have to really
fair these are uber smart people. I have great respect for Stan in particular and Jeff. But you have to be careful they're not talking their own book, A. And then B, Kevin Warsh co-authored that article. He probably wrote it for Stan. You know, there's an interesting play there, having been in the room with Kevin, who's a smart, bright, very young, capable young man. He developed a reputation as a hawk, even though he never voted as a hawk. So I think there's a bit of a sort of correction here in terms of how he's trying to present himself. The criticism that I've heard of that article is that he's still campaigning to be chairman of the Fed.
Warsh is.
Yeah.
You think he has an ulterior motive in the way he...
I don't think this. I like him, but I'm hearing this. So, you know, on the other hand, just to be fair to Kevin, he did create an image as a hawk, even though he didn't vote that way. And now I think there's a bit of an effort to correct that image. I also think he's sincere in what he argued in that article. So I'm not one of those critics, but the critics are saying he's trying to position himself to be perhaps succeed Powell under President Trump.
You say that it's in the market, discounted by the market. Are you sure about that? You think the market's really ready?
I do. Look
for that
for today. Yeah, absolutely.
Well, I mean, the Dow's up 250. That could evaporate in a nanosecond. We've seen that.
Powell's made it very clear. He said this publicly. Our job is not to underwrite the equity market. Our job is to do what's right for the real economy. And right now, the real economy is still proceeding.
I just wonder.
I'm sort of on Jamie Dimon's wavelength here, not on the other wavelength that you mentioned, Gundlach and Druckenmiller.
I mean, the criticism is that the Fed's been looking at the wrong data. I mean, the PMIs and all that, sure, they suggest the economy's strong. The FedEx economy, the PPG economy, the Micron economy, the economy of all of these other companies that have been impacted negatively by tariffs and trade and some of these other issues. That's what the market's been listening to. Maybe the market, with all due respect to your former colleagues on the Fed and to you personally, maybe the market knows more than the Fed does.
Well, I think the market always knows more. But remember, this market was pumped up. I like to say we had a bump stock monetary policy, okay, adding the balance sheet to zero interest rate policy. Now there's just a price being paid. We warned about this at the meeting. Jeremy Stein, myself, Tom Hoenick of Kansas City, and some of the others. There will be, including Jay Powell in his first meeting, June of 2012. We're going to pay a price for this. We have to be careful, and we have to make sure we don't let it get so far carried away that you have an enormous snapback in terms of correction. We floated the markets at the Fed. There's no question about that. And now the question is, how far did this run? So the market bottomed at 666, the Book of Revelations number, in March of 2009. It's now, today, as we speak, trading at 3.8 something X. So it was up to 4X. That's 14% compounded since that intraday low. That's a hell of a run. And markets come and go. So I think you have to be careful not to read this into Fed policy or just trade policy, whatever. The companies you mentioned are globally exposed. And FedEx, Fred Smith made it very clear. Europe and trade have been big in hindrances of issue, but he didn't call for the Fed to stop its policy.
I want to open it up to the desk. You've heard from the former Dallas Fed president, Kate Moore.
Yeah.
Should the Fed go today?
I would be really surprised if the Fed didn't go. I'm going to go with the camp of people who know better than I do on this one. But I just want to sort of push back on this idea that the equity market would rally if the Fed paused today. I think if the Fed stepped away because they were worried about a deterioration in data here in December, that would be, I think, a nail in the coffin of already awful sentiment across the equity market. I think what we want is that, the Fed feels that the economy right now is fine, that they will continue to be data dependent throughout 2019, but they're not so stressed out and worried that there's an about face in the path that they had already discussed with us and communicated with us. And I think that there's a bit of a buyer strike going on in the equity market at this point. Into year end, we see this in real money and hedge funds across asset allocators as well. And I think that actually we'd have selling pressure as a result of the Fed not moving today as a result of or instead of a rally or relief.
You think it would exacerbate some of the concerns that we already have about the economy?
I think it would stress, all of these cyclical sectors. I think it would stress a lot of the views for the more globally oriented companies. And I don't want to see more selling pressure. I want confidence coming out of the Fed today. The economy is in fine shape. We'll continue to be data dependent. Stay tuned as we watch the evolution around the rest of the world.